All right, we're going to go ahead and get started. Good afternoon, everyone. Thank you for attending our Talking Taxes Schedule A webinar. My name is Kiani, and I'm with TBP Professional Solutions, and I'm very excited for what we're going to be showing you guys today. Once again, this is our Talkin Taxes webinar series. We do this on a weekly basis every Thursday at 2 p.m. Eastern Time. And like the description says, we talk all things taxes. So without a further ado, I'm going to go ahead and get started and introduce our speaker today. So Jason Garner is our speaker. He is the president of TBP Professional Solutions, also an enrolled agent and owner of Garner Tax and Accounting. He has over a decade of experience in the tax industry, and he hosts these webinars every Thursday with us. And so today he's going to be talking a little bit about Schedule A's and the different type of itemized deductions that you can report to help maximize your clients' refunds. If you guys do have any questions throughout the presentation, feel free to write them in the chat. We also have the Q&A open, or you can unmute and ask a question. And we're also live on Facebook right now as well. So if you have anyone else that you think would benefit from this information, feel free to go share the Facebook Live, and that way your friends and tax professionals can learn about Schedule A's as well. So, Jason Garner, why don't you go ahead and get started?
Thank you, Kiani. Kiani, can you hear me fine?
Yep, I hear you.
If you can hear me, I'm going to assume everyone else can hear me. So thank you for that introduction. And thank you, everyone, for joining us today. And I will go ahead and do a screen share with this presentation so you can see me as well. We think it just adds to the presentation value of what we're doing. So, hello, everyone on Zoom and everyone on Facebook Live. Very glad that you're with us today for this week's Talkin Taxes. This week's Talkin Taxes is about the Schedule A. Schedule A has become kind of a hot topic the past few years with some tax law changes. So it's something that we want to be very well prepared to explain to our clients. And we'll talk about a lot of examples, and some of them are being a little bit more funny than others as we go through. But we always have that client that comes in and says, well, I spent $6,000 on medical bills, or I donated $1,000 to my church. I'm expecting a much bigger refund. And then we have to go into explaining itemized versus standard, what counts, medical limits. And we just want to be prepared to have those conversations and really be able to max out tax returns for our taxpayers. So our agenda today is going to start with an overview or the purpose of the Schedule A. And then we're going to talk about the itemized deductions versus the standard deductions. And that is something that has changed the past few years. And that's why you're seeing less Schedule A's now. We're going to specifically look at a breakdown of the Schedule A. So we're going to look at the different parts and what each one entails. Then we're going to move into the Schedule A within the TBP Pro desktop application and actually prepare one and show you some tips and tricks, including a few things I've picked up over the years that might be able to help you as well. We always end our presentation just giving you a brief explanation of what TBP has to offer and an invitation to join our community. Because today's presentation is brought to you by TBP. TBP stands for Taxes, Bookkeeping, and Payroll, and we offer a one-stop shop for all three of those services. I invite you to check out our website at www.tbppro.com. Or as Kiani said, check us out on Facebook, where we're live now at TBP Pro Solutions. Just search for that when you're in Facebook. So let's go ahead and let's get started. I like to start out with a quote when we're discussing ours, and we'll start out with one from Will Rogers. The income tax has made liars out of more Americans than golf. And just kind of a funny quote just to break the ice as we get started. But I thought that specifically applied to the Schedule A. A lot of, obviously the Schedule C as well. But the Schedule A can be a controversial form. What's going to count? When am I going to count it? How am I going to count it? Am I going to get to count it? And that's what we're going to talk today, because we don't want taxpayers that are liars. We want taxpayers that are maximizers, every legal penny. And we want to make sure that we're doing that for them so that they come back for years to come And we want to make sure that we're talking that talk and portraying that confidence when speaking with them, letting them know that, yes, we're doing this to maximize their tax liability or their tax refund, minimize their tax liability, and to get them the most from the professional service that we're providing. So, what exactly is a Schedule A? What's the purpose of a Schedule A? Well, the Schedule A is where you list certain items that you've paid for through the year that are per the IRS revenue code that can be added together to reduce your tax liability. And we'll talk about a lot of examples as we go through. But there are certain things that you have the option of taking on your taxes. Now let's talk about a few of them, such as medical bills. Big caveat with medical bills, though, as we'll discuss as we move forward. We've also got taxes that you've paid, such as real estate taxes, charitable contributions. So it's a form that let us list these payments that have been made out and add them together so that we subtract that on our 1040. So what we do is we add these together, we get a total, and then that amount is actually subtracted from the taxpayer's income, and that gives us taxable income. So everything on our Schedule A is basically what we could refer to as free income, so to speak. Because when we list that or when we use our standard deduction, we're actually taking that off our income. So we get a taxable income number. So we're technically not paying taxes on that income. And as we go through and I show you some form examples and work in the software, I think that'll be crystal clear. But basically, what we're doing is we're removing income from our tax calculation, coming up with a taxable income, and then we're just taxed on that. So, and with 99.9% of IRS rules, there's always other factors and what ifs, but usually the bigger Schedule A total is, the less taxes you're going to pay. But always an asterisk or a star next to a statement like that. It is an optional form. Not everybody uses it. And we talked about the past few years that a lot of people have not been using it. And the reason is because the standard deduction increases. And I like to use the term it competes with the standard deduction. You're going to use one of them when you prepare a tax return. You're either going to use your standard deduction or you're going to use your Schedule A, your total itemized deduction. Can't use them both. And that's why we get a lot of questions a lot of time as tax professionals. Well, I donated $1,000 to my church, or I paid this much in medical bills. That's why we get that confusion a lot, because a lot of our taxpayers think that that money is immediately coming back to them or it's going to immediately reduce their tax liability. They're not factoring in the standard deduction that they're already getting. So when we explain, yeah, you're not using that, we don't want to just say, yeah, we're sorry, that $500 to your church, God's thankful, but the IRS isn't. We don't want to come off like that. We want to explain why we're not using that. We're actually using a bigger or a bigger deduction for them. So that's our purpose of our Schedule A. We're going to add up certain expenditures that we had through the year, and we're going to see how much that is. And if that's bigger, in most cases, another asterisk, than our standard deduction, we're going to use that to reduce our tax liability. So let's talk about that standard deduction, because a lot of returns use the standard deduction now. So this is a predetermined rate. IRS puts this out every year, and you get to use this mostly based on your filing status. So according to your filing status, single, married filing joint, married filing split, head of household, qualifying widower, you get a certain amount of a standard deduction, or you deduct that amount directly from your income to calculate your taxable income, just like we were talking about. So every taxpayer, well, almost every taxpayer in America has that right off the bat. And that's why there is a percentage of the population that pay no federal income tax, because they may not have income past their standard deduction. And that happens, and that's where you see that stat sometimes. So, as we said, it's mostly based on filing status. There are some exceptions. Age At a certain age, you can increase that standard deduction or blindness, and that's why we have those check boxes in the tax software, if you've ever wondered that. And also dependency. If you are a dependent on someone else's tax return, you're not quite getting that full standard deduction that everybody else is that's not filing as a dependent. So standard deduction is something real easy. It's built right into the software every year. It's one of the things that you pay for when you get your tax preparation software. You just need to be aware of it and be able to explain it. Here's what they were for this last year for the 2009 filing season. Should be the same for this upcoming year. And I wanted to compare them to 2017 because that's when we had a big tax law change. So, based on these filing statuses, and these are the 5 filing statuses on a tax return, if you're single, you're going to immediately write off $12,200 off your income to calculate your taxable income. So, and this is also why the IRS has the filing requirements rules, because there is a form or a interview sheet or something along those lines on their website. Do I have to file? And one of the questions is they're going to determine if you don't have $12,200 worth of income, we know your standard deduction is going to reduce your taxable income to zero. If you've got a taxable income of zero, guess what? Don't have to file. Now, you may still want to if you had any withholding or some tax credits or something, just something to keep in mind. And you can see each one of these. And they're almost doubled from 2017. So, with these tax changes, the standard deduction had very big increases. So, everyone was able to come in and use these standard deductions. And this is why the past few years we've seen a lot less Schedule A's. A lot of like if you had a Schedule A, let's say you were single, and 2017, you might have had $8,000 worth of itemized deductions. So you may have came to your tax professional, in case whom I'm speaking with, and that person may have brought their 1098 for their mortgage, their charitable contributions, maybe medical expenses. They'd had that packet of information to give to you, and they're used to you filing that. Now, starting in 2019, that necessarily isn't the case. You're still going to look at that information, you're still going to see, but they're actually getting a standard deduction of 12,200. So probably 99.9%, there's no need for them to itemize. Because why take the 8,000 when you can take the 12,000? And that's just one of those conversations that we need to be ready to have with taxpayers. You've probably had them numerous times. I'm probably preaching to the choir. Probably the past few years, you're just you're like you're like a tape recorder. You just hit the button and you say, well, the standard deduction increased. You now have a much larger deduction based on your filing status, and we don't need to itemize your deductions. You may have that answer already, but at the same time, you may not. And I just want to be sure, because that's one of the reasons we put these webinars out, is to make sure that we're talking the talk and getting the most for the client refunds. So that's standard deduction. I wanted to use an example here, and this is a screenshot straight from our tax preparation software. You can see line 9, standard deduction or itemized deduction. Remember, you're only using one of them, right? And most of the time, you're going to use the bigger one. I'm going to show you a little trick, especially where I am in the state of Georgia, to where sometimes you might not use the bigger one, and it has to do with the state refunds. But if I'm looking at this as 18,350, if I go back to the slide before, I've got the 18,350, so this was obviously a head of household filing status that I used. So the software is going to look at that filing status, automatically put this in line 9, and just like we talked about, this person's AGI, or adjusted gross income, was actually $44,670. Now, because of the standard deduction, because of the filing status that they're using, possibly a few other factors, they get a standard deduction of $18,350. So we're going to pull that standard deduction down, working our way down this 1040. Their taxable income is actually only 26,320. So our standard deduction, or the total of our itemized deduction, is a very nice tool for lowering our tax liability, because what it does is it lowers our taxable income.
Jason, we have a question in the Q&A, if you don't mind.
Okay.
Leslie Thomas says, or is asking, when you enter the itemized deduction amounts and it is not more than the standard deduction, will it automatically take the greater of the two?
The software is defaulted to automatically take the greater of the two. However, as we're working within the software, I will show you to where you can choose to take maybe the itemized deduction instead of the standard. Now, 99 times out of 100, that's going to result in a lower, well, maybe not 99 out of 100. Most of the time, that's going to result in a lower federal refund. But there are certain states that count the itemized deductions a little better. So I have prepared a few returns to where I have marked itemized deductions anyway to get the higher refund on the state. And I'll show you that as we move on. But to answer your question a little bit more concisely, it does give you the larger one. Now, thank you for that question. Itemized deductions. Now let's talk about what actually goes on a Schedule A. Itemized deductions are various personal deductions that we're going to put on there. And here's just a few examples because we're going to go through these Schedule A. But you've got medical and you've got dental expenses. And a lot of people come in with a preconceived notion of large scale medical procedures are going to automatically qualify them for thousands in refunds. And we're going to talk about that. There are taxes that are paid. Most notably on that are property taxes. Those are some of the largest tax bills outside of federal income and state that people pay. So we're going to talk about that a little bit. Interest, specifically mortgage interest in the form 1098, and also charitable contributions. So these are the four main things that we're going to look at on the Schedule A. And let's talk about the first one, the first section. And again, borrowing screenshots directly from our tax preparation software, which we will move into as we go through a few more screenshots here. Let's talk about this because we've got medical and dental. And we got some nice calculations built in to help you with this. But it's really not so much about the software as it is explaining the Schedule A. The software just helps explain it, if you will. Medical and dental expenses, you actually can count your mileage back and forth for those. So trips to the doctor, the hospital, surgeon, et cetera, et cetera. IRS allows us, at least this last year, 20 cents a mile. So instead of having to force that calculation and you do that, just come in and type in your mileage here. And then at 20 cents a mile, we have a $69 deduction. Now, below that, we've got some long-term care premiums that can also count. We've got a max based on age. That calculation's built in there. But what I really wanted to get to was this line that I left blank on purpose because a lot of times these are coming from worksheets in total. This is where I'm putting in my other medical bills. So I just chose a number 3,500 to put that in there because when it comes to medical and dental, one of the things that you need to be aware of course, the software is going to calculate it for you, but this is just for your knowledge and also for explaining to your taxpayers. They are what we refer to as limited by 7.5% of your income. Now, we had that example earlier. I believe that income was somewhere around the 40,000 range or something like that. But what we have to do is, oh, actually, it's right there, excuse me, 44,670. What we have to do is we have to take 7.5% and multiply our AGI, our adjusted gross income. And if you keep in mind, that's before standard deduction, that's not taxable income, by that 7.5. So that 3,350 or that 3,050 is our limiter, if you will. That's what's limited. So what that means is I may have spent 3,569 with my mileage, but because of my income sitting at 44,670, I'm only counting $219. So when we say limited to 7.5% of the income, that's what we mean by that. We're taking that 7.5 and we can only count things that go over the 7.5%. In this case, anything over 3,350. Now, keep in mind, these calculations are built in to where I just have to have my totals and enter them. But again, It's something that we want to be ready to explain and talk the talk with our tax professionals because a lot of medical bills are substantial now and they don't seem to be getting much better. And a lot of people can come in with 5, 10, or even much more as far as medical bills. And they're expecting that to positively affect their tax return. But think about this for a second. This taxpayer is coming in with that number of $3,500 in their head. Not only are we limiting to 7.5%, we're only counting this if we itemize. So we got to keep that in mind as well. So we've got $3,500 on this Schedule A. So far, we've got a $219 tax deduction that we're using. So far, we're definitely not itemizing. Now let's talk about taxes. We got a lot going on this particular one with some calculations built in. And I'll show you some of these as we move into the software. But one of the first things we want to talk about are the state and local taxes. Also a hot button topic with the latest tax law changes because there is actually a limit on how much we can count on these now. But if we stop or start at the top, enter the amount of state sales tax. Now, this line below that, this 1,000, is actually coming from the combination of the W-2 withholdings in the information entered on your W-2s within the same tax return. So the amount that you've paid into the state, we're actually going to be able to use that as an itemized deduction because that's a taxes you paid that are not federal taxes, and it is state income tax. So we're actually pulling that number usually from the bottom of the W-2. Now this bigger number here at the top, the software has tax tables built in because you technically are able to deduct your state sales tax. Hardly anyone goes in and calculates and keeps track of their state sales tax for a whole year. I mean, it's essentially everything that you buy, except maybe for those tax-free school supply days or something like that. So no one really tracks that. So what they do is they generate tables based on your income. So all that means as far as you is based on what the IRS does, they basically look at your income and say, we assume you spent $400 on taxes, on state income taxes for the year. So we're just going to put that number in there for you. We're just going to give you that one. We assume you spent that. That number is probably lower than what you spent, but if you don't like it, tell them to keep records all year of every receipt, and then we'll go from there. Now, that number, that 3917, is a little high because I also went in and and I'll show you this when we get to the software. I did put the purchase of a vehicle on there. So I did put a high dollar item at a 7% sales tax rate, which you can count that as well. And you will get that question a lot. I bought a vehicle last year. Is that going to help my taxes? And like most of our answers in the tax profession, the answer is maybe, because we'll have to see how much it is and then we'll have to see if you itemize. So we definitely want to take a look at it and I'll show you where to enter that. Something else as we move our way down, state and local real estate taxes. Now that, depending on the state you live in, can be a very big expense for you to take on your taxes. In this case, I just put a nice round number of $6,500. Now keep in mind that with this, you've got a limit on this because I intentionally made this number go above 10,000 because the combination of these numbers here, as you'll see line 5E, you have to take the smaller of 10,000 or 5D. So what I did was I took my state and local taxes plus my real estate taxes, made that number more than 10 to show you that there's a limit on those two numbers combined of only $10,000. Now, in some states like New York, New Jersey, property taxes are well ahead of that. And that was something that was controversial with this line of tax law changes. But you've got your 10,000 there. And some states made changes to the way they itemized because of that. So then also you've got car and truck property taxes, or if you wanted to spell them out as ad valorem, those can count as well as other taxes. And those are the tag fees that you pay for your vehicle tag. Now, a lot of states have moved to paying all that up front. So that's something that you might just count 1 year instead of year to year. So those are the taxes that we can list on Schedule A. State and local taxes, bear in mind the tax tables are built into the software. state and local real estate taxes, limited to 10,000, and also some other taxes as well.
Hey, Jason.
Yes.
We have a question in the Q&A. This is
Uh,
from Natasha Ford, and she's asking, what's the name of the table that gives you an estimated amount of sales taxes?
That's a good question. I've always just called it IRS tax tables. I'm not sure if that is the specific answer, but I believe it's just the IRS sales tax tables that they use. But good question. Built into the software, so it should calculate for you automatically. So let's move on to the charitable donations. And you're welcome, Natasha. I saw that thanks pop up. Let's move on to the charitable donations. Now, this one is a little tricky too. And if you've taken the EA test, you get this question a lot. Um, Someone donated $300 to a family member who needed money or was really down, or I mean, just what kind of other example it could be. And they're trying to basically reinforce the tax law here that these charitable donations have to go to certified nonprofits, is what we're looking at. So, charitable contributions or charitable donations on a personal definition level can be to family members, to people you see on the street. To an IRS definition, that's a qualified nonprofit. So, I just stuck a few examples in here. Like, for example, if you're going back and forth to volunteer, you can actually count that mile. Now, we talked about business mileages in another TVP webinar, and that is recorded on YouTube. But I believe that was 55, 59 cents a mile for this year. You're only getting 14 cents a mile on the charitable contributions. Of course, that's built into the software for you. So you enter in the total mileage, which is 431 miles, that's $60. I did list local church for the next one. Most churches and charities, um, whatever they may be, are going to be certified nonprofits. They will typically provide you with a statement at the end of the year. Well, they should provide you with a statement at the end of the year showing what you donated throughout the course of the tax year. So I have that number in here. And there's also, and a lot of people miss this one. If you're itemizing, this is a good one to take advantage of because a lot of people do go to the Salvation Army or to the Goodwill and they drop off things all year. Now, it may be junk to you dropping them off, but that actually is considered a non cash contribution to a qualified nonprofit. And they'll typically, when you drop them off, they'll just give you a little form and you're supposed to fill it out yourself, or they may come in and write down what it was. And you can technically count the fair market value of what you're giving them. Word to the wise piece of advice, keep that fair market value low. You don't want this to cause an audit on your return. And also, at $500, the Form 8283 is required. Well, excuse me, over $500. So anything $500 or less, you can just do like I did here, put the total, Salvation Army, $400, and you've got yourself a small but usable tax deduction on your Schedule A. Sometimes $400 is the difference between itemizing and not. So we put that, and also, like I said, if we go over 500, we actually need to list out everything donated. Now, it doesn't mean we need to stray away from that form. People donate cars. You may have heard the commercial Cars for Kids. People make large donations to their previous alma maters or things like that. When this happens, we just want to make sure that we're using that form and we basically just list out what it is, how much we bought it for, fair market value at the time of donation, and that's going to carry over into this particular form. The last little section that we'll cover today has to do with casualty theft and other. Casualty theft now is pretty much just federally declared disaster areas. So you've got the California wildfires, you've got a lot of the hurricanes that come in, especially in Texas. Individuals in those areas certainly have a better chance of itemizing. You have car damage or something like that, or something that's lost or destroyed that's not completely covered by insurance, you're probably looking at a casualty or theft loss. You've got other itemized deductions, some of these coming from other forms like a 1041 or the K1, because if you've got 1065 or an 1120S and it makes a charitable contribution, guess what? It just comes straight to your tax return where you may use it or may not. But you've also got gambling losses to the extent of gambling winnings. Sure, you get that question a lot. A lot of people try to use that. So that's only to the extent of the gambling winnings. So the best you can do on your tax return with gambling losses is overall zero. So let's go ahead
Yep.
and
Hi, we have a question in
okay.
the chat. So Brian Bruton wrote, and he said, I have a client with a home office in Georgia. Employer is a Canadian company and pays my client with a W 2. My client does have legitimate home office expenses, includes some mileage. How do I deduct now?
That's a very specific question on that one. So a client with a home office in Georgia, employer is a Canadian company and pays my client with a W 2. I assume a US W 2, a legit home expense, including some mileage. How do I deduct now? That one is so specific. I'd like to address that one individually, either at the end of this or probably get a little bit more information on that one. Brian, thank you for that specific question. Let me get back to you on that one because we are talking about probably something that was changed recently with or non-reimbursed employee expenses in a home office. So I'm thinking there may not be a lot with that, especially with a W 2, but I would like to look into that. And what I'm getting at is when we had non reimbursed employee expenses, we were able to do home offices on that 2106. That form has changed a lot now to where not many people are using it. So that W 2 term is sticking out in my head. And I'm going to probably say there's not going to be much that we're going to be able to do with that for a home office. So let me address that individually, Brian. But I'm thinking off the top of my head, there's not going to be much I can do with that one.
Great. And then another question came into the Q&A from Jorge Paredes. He said, didn't you have to have gambling winnings in order to claim losses?
Yes, absolutely. And that's what we were talking about. Like you, to the extent of gambling winnings. So you've got to show gambling winnings on another part of the return. I believe it's on the 1040 or maybe even the Schedule 1 now to use those gambling losses. So two good questions on that. Brian, I won't forget about that one. And whoever asked that other one, thank you very much. Now let's go ahead and let's talk about some forms that are usually related to the Schedule A. The 1098 form is a mortgage interest statement. So if you're paying a mortgage on your house, it is required by tax law that you get one of these forms, and you're usually going to get it by the end of January. We talked a little bit about the federal declared disaster areas. That's going to be reported on Form 4684. We did talk about the Form 8283, and what we said is if you go over $500 on your non-cash charitable contributions, you're going to have to list out what each one of those contributions are and fair market value for each one of them. And one that I put on here anyway, that's not necessarily a IRS supported form, the charitable contribution statements is something that your taxpayers want to have especially if they're making rather large donations to a church or a charity. And they typically will get those by January, February of that tax year. So see, those aren't necessarily filed like a 1098 or even a 1099 for that matter. But you'll get like a sheet of paper or just something that lists out and gives you a total on those. It's not like a proper form, but you still will get those. And that takes us to where we actually move into the software and put some of these numbers in motion. And I think a lot of this will be crystal clear once we get into that. So we do have a tax return started in TVP Desktop, and this is actually the screenshots that we use. So we can go in, kind of adjust this, show you a few tips and tricks as we move through and show you how these calculations take place in real time so you can kind of see it. Like for example, on the mileage, like I talked about, you put in your medical and dental expenses mileage, will automatically calculate for that, so you got a $100 deduction. Now, the 3,500 that I left on the blank line for the medical expenses was intentional because I do like to point out, especially with large scale medical procedures, that's hardly ever going to be one bill. Like when my wife and I, when she had our children, we got bills from the doctor, from all kinds of different areas. And if we wanted to use that, it would be my strong suggestion to use the worksheets feature. And that's a link down at the bottom of the screen. And this simply just allows you to come in and list each one of these, whether it be doctor bills and then prescriptions. But it just gives you a much better paper trail of what's going on with each one of these. I think I misspelled prescriptions. I'm a numbers guy. Don't hold it against me. But as you enter this information in here, it's going to total for you. You can see now that it's got the 4,600 here, and it's going to total that line as you're moving. Keep in mind, we still have our limiter. So this 44,670, that's from my AGI, which means times 7.5 or 0.075, that's my number. I only get to count any dollar that's over that. So $3,351, I have a $1 medical deduction.
Hey, Jason.
Okay?
We got a question from Natasha Ford. She's
Uh-huh.
asking, is mileage also counted for dependents?
Mileage also counted for the, like if you're taking the dependent on a tax return for a medical and dental, then yes. Let's talk about taxes paid. Now, we talked about this one a little bit, and I really want to break down this calculation because the software has a nice worksheet built into it. So enter the amount of state sales tax paid here. So I'm going to click on worksheets, and a lot of this is going to be filled out for us. And you see, enter your state general sales tax from the applicable table. Software is looking at the IRS tax tables based on your income, puts that in there for you. So they're saying, look, based on your $44,000 worth of income, you probably paid around $417 in state and local taxes. We'll let you count that. So there's where your 417 is coming from. Now you got some other factors that time purposes aren't going to let us get into today, but we want to look at line 7. So line 7, any large expenditures. So if you buy an airplane, tell your wife it might help on the taxes, or your husband. You want to buy a boat, might help on the taxes. And what I did was I put $3,500 in sales tax for a car, and I believe that was right at 50,000 and 7%. 7% being the taxes in my home state of Georgia. So that is just picked 50,000 and put in that 3,500. And what that's doing is just adding that number to that 417. So the IRS is still saying, well, you made this much money, you probably spent this on sales tax. This is any large purchases that would add to that. So based on the tax table plus the large purchase of the vehicle, my state and local taxes are $3,917. And what did I have to do? Basically just ask, did you buy anything big last year? What was the sales tax on it? Software took care of the rest. You can see that number now is adding here and to the one, I'm sorry, taking the greater, 3917 or the state income taxes paid. And that $1,000 being a gray field is actually coming from my W-2. So you can see that number is just coming right over because we know that's the state tax paid so far for the year. So we're taking the bigger $3,917 or $1,000. In this case, it's obviously 3,917. I did come in and put my real estate taxes on line 5B. That's typically also going to be listed on your 1098 that you get at the end of the year, the mortgage interest statement that we were talking about. Most mortgage companies will pay your real estate taxes in escrow. So they'll go ahead and put the amount that they paid on there. Now, you'll probably also, from your county tax commissioner or state tax commissioner, get a tax bill as well after your mortgage company pays those taxes. So you may get that number listed on 2 forms. In this case, I put 6,500 and then it carried over to 5B. Again, for time purposes, not going to be able to cover, but the software has some nice calculations built in to where, like, if you've got the 8829 on a Schedule C, or you've got the real estate adjustment from a house that's part rental, part personal, it'll actually adjust based on the percentage and give you some of that real estate tax on your Schedule A. So a nice calculation built into that. We got our running total of 10,407. Remember, we've got a limit of 10,000, so that's what we're going to take. And then again, just stuck an ad valorem tax for a vehicle tag on here for 250, giving me a total of 10,250. If we move down to our next section, which is interest paid, this is a very simple section. Now, a lot of times you will get a 1098, and you really want to see a 1098 as a tax professional. You want to make sure that they have that before entering these numbers. They could log into the website and get it real easy these days, though. A lot probably faster. They get it in the mail now. But this is where the mortgage interest will be totaled. Notice that you do have it for two mortgages, whether it be that you refinanced, you could use this because it's just going to total it, or it could be a home and a RV, because we can actually count the mortgage interest on those as well. So we would actually just take the total of the two of these and total these together for you. You got some other adjustments on here, things like that. Most of the time, you're going to be in these two lines, the first and the second, and a lot of time it's just going to be the first that you're going to be using. However, I did want to point out line D for the mortgage insurance premiums. Now, these are limited based on income. So you see I put the $1,500 in the light blue field, and it did give me a $1,500 deduction. Now, I believe the income for that is at 100,000. So if I make this W-2 120,000 and go back to my Schedule A, even though I've still got my 1,500 listed, now I'm not getting that deduction. So it kind of takes some of the guesswork out on your end. You see MIP on a tax return, just go ahead and enter it on this line here, 8D. We'll do the calculation for you. I'm going to go ahead, and I don't like seeing that 12,000 owed. I'm going to go ahead and put my 40,000 back in here. And I must have had a different number earlier, but that's okay. We got my 40,000 and continuing to work my way down. Again, we've got a mileage calculator for the 14 cents per mile for mileage driven to for charitable purposes. Remember, certified nonprofits. Not going to go help a buddy move. Even though I'm doing that tomorrow, I'm not going to write off that 14 cents per mile. I'm not even buying breakfast, and I'm not going to write that off either. But when I go to church on Sunday and put in an offering, I am going to list that, well, at the end of the year. And that is, I also like to use worksheets for this one, because a lot of people may donate to numerous charities and their local church, and I like to spell those out. I like to use this worksheet, and then you can come in and list out your deductions so that you got these listed out, and it'll give you a total as you're running. Excuse me. Line 12 is our contributions other than cash or check. Notice that I list out Salvation Army here. If you've gone to multiple ones again, I do stress the worksheets. So you got the worksheets here, and this is where you can come in and list multiple ones. So if it's also to Goodwill for another $50, I'm going to keep it under 500. We do that, and that's going to total that number for you here. All of these are going to be totaled as you're moving through. And you're going to see this number on line 14. The last section we'll talk about, and we did get that question earlier, don't your gambling losses have to be offset with gambling income? Yes, they do. I am going to remove that just for simplicity and better example purposes, because I did not include gambling winnings earlier in this return. But this is where, on these federally declared disaster areas for casualty and theft loss, notice this is a gray field. This is where you're going to do your form links and link to this specific form, which is one we referred to earlier, the 4684. And this is where you're going to have to come in, and you're going to have to get the FEMA number, and you're going to have some other information that's going to be entered here. You're going to have to list the property that was destroyed. You're going to have to list any insurance reimbursement that you got. But the form is going to take care of those calculations for you and total them here on 15 along with the other deductions and give you a total down here at the bottom of 25,960. Let's pause for a second.
Yeah, we have a few questions in our Q&A. So first question is from Marilyn Meredith, and she's asking, what authority can you add ad valorem taxes on vehicle to the $10,000 limit?
What authority can you add ad valorem? I'm not sure I'm understanding that one. As the ad valorem listed differently and going over the 10,000, I guess that was the specific question. So that being the case, if that with the 10,000, I don't see that a lot in Georgia because the property taxes are lower. If that's the case, not going over the ad valorem, that might be a mistake to put that there. That might need to be on the car and truck taxes. On that one, I think I'm getting what Marilyn is pointing out on that one. So that one I may need to resend and put that example on line 5C and not include the ad valorem on there. Thank you for bringing that up.
Next question that we have is from an anonymous attendee, and they're asking, please mention when mortgage interest is not deductible.
When mortgage, well, there's a slew of different rules in which that's going to be the case. Getting back on the 10 till the hour mark on this one, there are some income limits, and it also has to be for, if it's not, this is for personal use. So this is the principal home that we're using it on as well. So there are some income limits, and it does have to be for your qualified principal residence in which we're going to count that.
All right, another question coming in from Shirley Scott. She's asking, why do you have to mail GA state in, Georgia in?
Don't have to mail that in. I was saying that I don't see a lot of the 10,000 limit in Georgia because of the property taxes being lower than a lot of other states. Definitely Georgia has e-filing of the Georgia 500. Automobile sales tax, does it have to be a new automobile? No, it does not. But if it's a trade-in, it's the difference of what you're also getting for your trade-in. So be careful with that one. Good questions, guys. Appreciate them a lot. I do want to point out my total itemized deductions here, 25,960. Software, I believe this question was asked earlier, will automatically give us the larger one. So the 25,960. Now, if I move to the 1040, is going to be on line 9. So I've got my $40,000 from the W-2, and I've got my 25,960 deducted from that, giving me my taxable income. So all I'm paying taxes on is $1,406. I'm sorry, $14,040. My tax, looking like I'm in the 10% tax bracket, is $1,406. So that's how that's going to calculate on that. However, I have noticed some states do calculate the itemized a little bit different. So I will show you this. My standard deduction on this, let's pull this down to a number I believe is going to be smaller. 21,000. I believe I'm filing with a head of household. Let's change that to married filing joint. And that is what I wanted to see. Now on my Schedule A, if I come down, my total itemized deductions, because what I'm just manually adjusting these for example purposes, is 21,260. So if you think about it, my standard deduction actually, notice how I don't have the red check mark next to the Schedule A. So if I go back to my 1040, now I'm counting my 24,400. So I'm not counting that Schedule A. Now, I can still, if I want to, there's various reasons that you might want to do that. I'll show you one specifically here in a second. But in order to do that, down at the bottom of the Schedule A, you can elect to itemize deductions even though they are less than your standard, just by putting an X there and refreshing your program. Notice my Schedule A has a red check mark already, and we just did that. Now, I'll show you one particular reason I do use this. We go to Add Form, and I'm going to add my state of Georgia on this particular return. And I want to make sure that I've got some withholding or at least enough withholding on this to show a refund on both my federal and my state. So now I've got a 3,500 roughly deduction federal and a 375 on my state. So I've got about 3,800, a little bit more, about 3,900. Now, in some cases, when you have the Schedule A and your itemized deduction is close, you can just check this in the software just by itemizing anyway. And you itemize anyway, what's going to happen? Remember, I'm about 3,900 total refund, 3,500 and some change federal, 375 from the state. If I do this, notice what happened. My federal did decline down to 3,200, but my state jumped all the way up to $1,200. This is perfectly fine. This is great tax planning if you want to do this. And it's state to state. May not be near as effective in your state, but it's something in Georgia that I use a lot. Now, my total refund from the two of these is about $4,500. So a pretty substantial boost in the total amount of money that this person is getting back. Just something to keep in mind if you're close on those itemized deductions, see what they do to that state refund when you're calculating. And, for time purposes, can't get into it. I think we'd need a week, but some of the states specifically altered their itemization and what they can count and what they cannot count because of the tax law changes that happened a few years ago. And there's all kinds of tricks and tips with the different states that you can look into using, especially when someone is itemizing.
Jorge said, "That's an awesome tip. Thank you."
You're very welcome, Jorge. Hopefully that works out for you. If I don't know what state you're in, but if you're in Georgia, definitely give it a shot.
And we also have from Quinn saying, "Buying an automobile can be used or new."
Yes, that's correct. Some of the resources that I used for this particular presentation, and thank you so much for coming today as we start to wrap things up. And this, by the way, this webinar will be recorded or is being recorded and will be placed on our YouTube page. So you can always go back and go through this presentation, share it with other preparers, new preparers for training purposes. It'll be on YouTube. Just search for TBP Pro. That's TBP as in taxes, bookkeeping, and payroll. Some of the resources I used in putting together this presentation, irs.gov, obviously, always lead with that one. Specifically, publications about Schedule A, publication 547. There is a nice specific web page, can I deduct my mortgage related expenses, and tax topic 500 for itemized deductions. Just some things to keep in mind when it comes to that. As we round the corner here, the software that we used today was the TBP Pro Desktop, industry's most reliable software. And that has text marketing capabilities, remote signatures, easy due diligence requirements. You saw some of the powerful calculations and how easy it was to go through and prep a return, see the real-time calculations on the forms themselves, built-in document management, multi-office setup, and especially if you're doing the bank product returns, we get some very nice pricing and rebates that we'd love to share with you. Of course, that's not the purpose for today, but we do also like to point out we're offering the industry's only turnkey solution to bookkeeping and payroll. With our system, you can be offering bookkeeping and payroll and generating monthly year-round income in days, not months or years. 100% supported by us, all software provided, including a proprietary client management system that we refer to as SmartNet. Additionally, we do make custom-made mobile apps. With a COVID-19 season coming up, and technically we did have a COVID-19 season last year, but this will be our first full season with COVID-19, and we don't know how that's going to go, but we are going to be prepared for it. And a custom-made mobile app that allows live streaming of meetings, very similar to what we're doing here, where I'm sharing my screen and you can see me, is perfect for people that still want their taxes done, but don't want to venture out just yet, especially into a busy tax office. And we wrap it up with being able to take a tax payment as well. Thank you again for joining us today. I appreciate you taking the time to go through Schedule A's with us. We always end our presentation with an invitation to join TBB Pro. I encourage you again to look at our website, www.tbbpro.com, and to check us out on Facebook, where this video is streaming live. Just search for TBB Pro Solutions. Thank you again.